How excessive worry of failure forces an investor to make the wrong decisions. Industry expert Amrita will enlighten us now.
So, how do you reduce loss aversion bias? Number one, whenever there is market volatility, be concerned, but not be overtly concerned. It's important because if you are not keeping your nerves calm, if you're not thinking logically, you are letting the amygdala take over. That means we will only be shivering and shaking, and blood pressure will only go up. Many a times, if we are looking at our portfolio by the hour, by the second, by the minute, by every day, if you are going to look at your portfolio every day, you are going to see losses more than gains. And that leads to loss aversion bias. That leads to myopia, short-sightedness. So I would request you not to review your portfolio on a daily basis, review your portfolio quarterly or 6 monthly or yearly, because the more you see it and look at it from a perspective whether your portfolio is growing as per your goals. Otherwise, just for a few 1,000 rupees profit, 100 rupees profit, if you're going to look at every day, you're going to see losses more than gains, and it will lead to loss aversion bias. If you are having non-performing assets, deteriorating financial instruments, and you're still holding on to it for psychological reasons, you have to ask yourself, what if I didn't hold this instrument? Will I still buy additional shares into it? When you ask such questions to yourself, then you will get the right answer. So loss aversion bias can be reduced, or at least can be appreciated if you reframe questions. Then consider having a stop loss rule. You cannot be holding into deteriorating assets always. Have a stop loss rule that if the asset falls by 25%, is not rising for the next 3 years, I'm going to get out of it. Similarly, have a price appreciation rule. So endowment effect's other cousin sister is called disposition effect, which means many a times we will think, no, equity may we have made 10% return. Now we will book profits. We don't want more than that. But probably that equity product had the capability to give you 12% return compounded for the next 7 years. That is 70-80% absolute gain. So you lost an opportunity to make money. So you should have a price appreciation rule, and which is linked to your goals. That if the portfolio is growing by 12%, it will not grow every year by 12%. But if it has given overall in 7 years a 12% CAGR and meeting my goal, and I'm getting that affordability and purchasing power, now I will redeem from the fund. So price appreciation stop loss rule also helps in taking care of endowment effect and disposition effect. Check the fundamentals, like what's the consistency of the product, what's the standard deviation, volatility of the product. If it is a debt fund, what's the credit rating, what's the credit quality. If it is stocks, as I've said, don't look at some fixated filters like 52 weeks high dividend yield stocks. You need to be a proper fundamental analyst. If you are not, then seek guidance of an expert, like a good expert financial advisor who can help you, who will entrust the money with good asset managers. And loss aversion bias can be reduced through asset allocation. There are different types of asset classes: equity, debt, gold, real estate, etc. Now, every asset class does not perform similarly in a particular situation. Say, for example, Israel-Hamas war led to equity markets worldwide falling, and also it led the Federal Reserve Treasury yield rising by 5%, also made a lot of FIIs in India selling money, redeeming from equity markets. Now, equity has not performed well recently, though it has recouped quite a lot of losses, but its performance year to date is little somber. But gold has done well. So when one asset is not doing well, the other asset does well. Similarly, when equity booms, gold does not do well. So every asset has some sort of a different or divergent performance or correlation with each other. So when you, just like we can't be eating only proteins. Our diet should have proteins, minerals, carbohydrates, everything, vitamins. Similarly, your financial diet cannot be only based on bank FDs and real estate. It has to have equity, it has to have debt, it has to have some commodities, it has to have international equity, because if one asset class or product is not doing well, it gets compensated by the other one that is doing well. So asset allocation is good, and there are pre-manufactured products from asset management companies like multi-asset allocation funds, balanced advantage fund, hybrid funds, which you can also consider.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances, then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free and you can find the link in the below description. Please like and share and do subscribe to Holistic Investment.